Okay, let's talk about trading bots. I mean, over the past few years, they've just exploded, right? They're everywhere. And the promise is super appealing. Disciplined, emotion free trading, running 24/7 to catch every single opportunity. Sounds amazing. But here's the kicker. What if that exact popularity is the very thing that makes them fail? What if your secret weapon is also everyone else's?
I mean, let's be real, it's the question on every single trader's mind, isn't it? Could a robot actually make you rich? Well, we're going to tackle this head on by digging into the research of one trader who went deep, and I mean deep, down this rabbit hole. He started questioning whether automating his own strategy was really the smartest move after all.
So join us for this one. We're about to pull back the curtain on what happens when a popular strategy gets, well, too popular. It reveals one of the market's biggest hidden traps. And hey, if you want to see how this whole thing unfolds and get more insights like this, now's a great time to click that subscribe button and join us for the journey.
All right, so that brings us to the big one, the automation dilemma. You know, on the surface, automating your trading, it seems like a total no-brainer. But the reality? Well, it's a whole lot more complicated. It's really a series of pretty critical trade-offs.
Okay, so here's the breakdown. On the one hand, yeah, bots give you perfect emotional discipline. There's no fear, no greed, just pure cold logic. Awesome. But, and this is a big but, on the other hand, that same rigid discipline means a bot will happily and consistently execute a flawed strategy right into the ground. It won't think twice. It's this constant battle between speed and consistency and the massive risk of that inflexible execution. And this, right here, this brings us to the absolute central question that drove this whole investigation. It seems like a simple question, but trust me, the answer, it unlocks the single biggest risk you'll find in automated trading today.
This question leads us straight into something called the crowded strategy problem. And it's exactly what it sounds like. It's the phenomenon that can take a winning formula and turn it into a losing one, basically making it a victim of its own success.
So to really get this, think about it like this. When it's just one trader, just you, making a move in the market, you're like a tiny, tiny drop in a massive ocean, right? The market doesn't see you. It doesn't feel you. For all intents and purposes, you are completely invisible. But what happens when it's not just you? What if it's 500 people all using the exact same popular bot, all making the exact same move? Well, suddenly that tiny invisible action, it becomes a massive herd. And a herd, my friends, leaves a footprint, a big one that's definitely big enough for the market's biggest players, the sharks in the water, to see. And that, right there, is strategy crowding in a nutshell. It's when a whole bunch of people start doing the exact same thing at roughly the same time. The behavior stops being random noise, and it turns into a clear, predictable pattern. And let me tell you, in the markets, predictability, well, that's the kiss of death for your edge. So how do institutions read the market? I mean, you're probably asking, who's actually looking for these footprints? Well, it's the big players, the massive institutional firms. Their entire systems, their whole reason for being is to find these exact kinds of patterns in that massive flood of market orders. Yeah, we're talking about the giants, firms like Citadel Securities, Jane Street, Virtu Financial. And here's the key. They are not looking for you, the individual trader. They don't care about that. What they're looking for are these big aggregate patterns, clusters of activity at the same option strikes, repeated combos of expiration dates, identical trade structures popping up over and over. For them, it is purely a statistical game. Now, here's a huge misconception I want to clear up. A lot of people think these firms then attack the retail strategy. But that's not really what's happening. It's way less dramatic than that. Think of it less like an attack and more like a simple market adjustment. They see a predictable behavior, and they just price that predictability into the options. It's just like how an insurance company would price in a known risk. It's just business. So let's walk through this chain reaction step by step because this is where the rubber meets the road. First, all those bots out there create a detectable pattern. Simple enough. Second, the market makers see that pattern and they price it in. What does that mean? It means they essentially make it a little bit more expensive or a little harder to make that same predictable trade. And the result? Boom. Step 3, the profitability, what traders call the edge, it just starts to shrink. It slowly fades away. Okay, I know what some of you were thinking. It's a common counter-argument. Well, what if we all enter at slightly different times? That'll hide the pattern, right? Well, the myth is that different entry times hide the pattern. The reality? Not so much. These large firms, they're looking at the bigger picture, the overall positioning in the market.
So even with staggered entries, if everyone is building the exact same trade structure around the same strikes, that aggregate position, it still becomes visible over time. It's all going to show up. So, if automation can create these crowded, predictable traps, how on earth does a trader survive? Well, this leads us to the final and I think most powerful conclusion of this whole thing: keeping the human edge. We're going to talk about where the real, durable advantage comes from in a world that's just full of bots. So, what creates this high crowding risk? Here's the crucial point right here. Extreme uniformity creates extreme risk. It's that simple. When you have thousands of traders using a bot with the exact same rules for everything, the same strategy, the same strike selection rules, the same expirations, the same entry timing, and the same adjustment rules, that strategy becomes incredibly predictable. And that makes it fragile. And really, that's the big overarching takeaway here. A trader's edge, any edge, often erodes slowly as more and more people discover the same idea. It's not a sudden thing. It gets ground down by its own popularity, especially when people start to automate that very same idea. Nothing lasts forever. And this quote from the original trader, High Noon Trader, it just captures the final conclusion perfectly. He says, "For now, I'm happy keeping the human in the cockpit." After seeing how all this automation can lead to these fragile, crowded trades, he realized that the real strength lies in what the bots can't do. Using judgment, adapting on the fly, and most importantly, avoiding the herd. The ultimate edge, it turns out, is keeping a smart human in that pilot seat. So it really leaves us with a fascinating question to think about, doesn't it? In this age of AI, where everything is getting faster and more automated, is the ultimate trading edge still human? Could it be that the most valuable asset isn't a faster algorithm, but actually a flexible, creative, and adaptable human mind? So what do you think? If you found this journey into the world of trading bots insightful, and you enjoy untangling complex topics just like this one, do us a favor and click that subscribe button to join us for our next explainer. We'd love to have you. Thanks so much for watching.